All right. Welcome to the show, Josh. Thanks for being here.
Hey, thanks, Lucas. Thanks for having me.
Yeah. So, for those who might not know your story or who you are, what you're about, give us like 30 seconds of who you are.
Yeah, sure. I'm a real estate investor who has primarily invested through my retirement accounts. Uh, I like to be open and honest kind of about my journey of how I got into real estate. And that stems from about a decade ago, my grandfather passed away. And then a few years back, we lost my mother as well. And so what that did was it left me with the retirement accounts of a baby boomer and a member of the greatest generation. So very quickly, we had to learn what to do with an inheritance as well as how to properly manage and deploy a number of IRA accounts. So the last few years, I have figured out the ins and outs of what you can and can't do with an IRA. We've done it in a two-step process where we started with um, lending out to flipping operators who needed private money loans, which we've done. And while we were lending out money, we have set up a multifamily syndication operation at the same time while our money was passively growing in the background.
Okay. So, you had like a terrible situation. You were backed up against a wall. How come you were the one chosen out of your family to get into this? Like, who made you the executor here?
Kind of me. I so the way my family works is I'm business minded.
Okay.
I opened up my first Roth IRA account when I was 16. I've
Okay.
actively traded and invested since I was a teenager. So I've always had an interest in investing. My two sisters, they're teachers. They deal with 5-year-olds all day. They wipe butts. They take kids out onto the playground. So
Okay.
they're helping the next generation, but they didn't really know what to do. So um, I wanted to make sure that if I was to take my opportunity seriously and do as much as I could with it, that I was going to bring my family with me.
hmm Yeah, that's really interesting. We've had this theme reoccur on the show a couple times actually, where family members are experience tragedy and they're left with this pool of money, and like, what do you do with that? It's such a daunting thing. So, how did you first find out A, that you could invest this retirement account, and B, how did you choose fix and flipping first, and how did that go?
Yeah, so this happened to coincide at the same time as when I was going through a career change. I decided at the time I was probably going to get involved in real estate. I thought that this would be the right vehicle to take it down, but I wasn't sure. I had no background in it. So I decided I was going to go get an MBA because that's what I had known my entire life. I knew that I should go to good school, get good
Yeah.
grades, go get a good job, go to get a professional degree to bump up that salary and add more money to my 401k. So it was the next step in the process. So I went
Interesting.
uh, to school again, and then 5 days in, I dropped out very quickly. I realized um, it wasn't going to be worthwhile for my entrepreneurial spirit of what I wanted to accomplish, of trying to accelerate my growth as fast as possible. So I decided to embark on kind of a self-taught curriculum. What that consisted of was diving as deep as possible into as many avenues as possible within real estate. So I looked at fix and flips. I looked at wholesaling, note lending, or note investing. I looked at every type of possible thing. And the thing I kept on noticing over and over and over, the reoccurring theme was every host of a podcast or writer of a real estate book, they all kept mentioning scaling up
Mm.
your investing. So you want to build, and then they eventually touch on, hey, someday I would love to do a multifamily syndication. So this word kept on popping up, multifamily syndication. So I looked into it, and I saw a few people speak on it. I went to a few events, and it started to make sense. So that is kind of how I decided what I wanted to do. I knew that multifamily was going to take some time to learn about, put into an operational practice, and then also just kind of find some deal flow. So I
Mhm.
figured the easiest way, I had this pool of funds, the easiest way possible was to go to a meetup and just start telling people I had money. uh, I would not suggest that for anybody who is in a similar situation. Maybe be a little more discreet about it, because a lot of people try coming after you for it. But luckily, I found some good operators through a mutual friend. We invested in some properties in Boston where I went to school. So I trusted the operators. I wanted to make sure that um, I wanted to have my money deployed with velocity while I was trying to learn and scale into multifamily, because I knew it wasn't going to be instantaneous. So I wanted to get it done, get it into private money lending as soon as possible, so I could earn my 12% or whatever you might
Mhm.
get on a note, while I was trying to build everything that I
That's
wanted.
great. I mean, not a lot of people would have the fortitude to understand that it's a long-term gain, and investing this money is something that's going to grow slowly. And so if you could put it into a couple things that, grew slowly here and there and here and there, and while you're educating yourself too, that's really cool. I mean, I had no idea that you were pursuing an MBA at one point too.
Yeah, it was short lived, so
5 days, yeah.
barely noteworthy.
But
Not
that's
noteworthy.
that's so important too. Like you had the courage to, drop out when you figured it wasn't right for you, which not a lot of people do.
Yeah, I mean, I had gone to business school, and my first class back was actually one of the professors I had already had since I went back to the same college,
Yeah.
and so he was teaching roughly the same course, and I realized that I needed to learn something new, and I needed to move on with my life.
Interesting. So I think your story is really gonna to resonate with people that are probably 2, maybe 3 decades older than you right now.
Yeah,
How did you figure out A, that you could even invest your retirement accounts? I didn't know that until, I was well into my real estate investing journey. So I didn't even know you could do that. So how did you learn that? And then how did you make the leap from investing in like mutual funds or an index stock exchange, whatever it is, to fix and flip reach real estate?
yeah. So I had gone to a couple different meetups, and a lot of the times at these different seminars, conferences, meetups, they'll have different vendors come and speak. Sometimes the vendors are custodians who take care of what's called self-directed IRA accounts. And so I saw one of these custodians presenting. It kind of gave me the idea. I didn't really realize that you could do this with your accounts. I'd seen that I was getting IRAs and I was getting a retirement package, but I didn't know that it was deployable within real estate. And I always kind of was relenting the fact that I wasn't going to be able to do it. So
Yeah.
when I saw that opportunity, I dove full feet in, because I knew that this was potentially going to be really powerful, that I could leverage this opportunity. So when I learned about that, I started to kind of investigate as much as I could online. This was about 2 years ago, I'd say.
Hmm.
And it's taken a long time to find all the pieces and put them all together, which is why I'm here, I guess, talking to you today, because I've gone and gathered all that stuff up, and talked to multiple vendors, multiple service providers, and lawyers and attorneys, and figuring out what you can and can't do. So, yeah, here we are. I eventually learned that you can not only put it in real estate, but you can actually apply leverage to it. You can take out a loan. You
Yeah.
can do all sorts of things within it that are very similar to what you can do with personal cash funds.
Hmm.
You're just kind of limited in terms of the transactions you can and can't take part in.
Yeah. So, what I thought was really brilliant about your company, Wall to Main, is the way you have consolidated, well, like you said, years of education on your end down and synthesize that down into like, here's what you can do, here's what you can't do. And it's a very simple platform to show people, like, here's how I went through this. What you've probably done it like almost 10 times at this
And
point,
close
right?
that. Yeah.
Yeah. So, you've gone through a lot of different transactions. You understand what you can and can't do. You've probably seen quite a bit. Now, for someone who's never done that before, that's a scary process to look down the road 10 transactions and say, okay, I'll figure it out. But you've taken that, cut that learning curve down, and just said, here's my experience, here's everything I've learned, and you give it away.
Yeah, at Wall to Main, I've kind of gathered up all the vendors that I eventually found. It took some time. I was on Bigger Pockets, and I found the guy who's set up all of my self-directed IRA LLCs. Um,
Hmm.
I advocate heavily for checkbook control over everything. Those presenters that you'll see at different conferences and everything, they're typically with custodians, and custodians like to charge you high fees. They like to charge you continual fees as they hold money, and they're actually holding. If you bring the money into a custodian and then you take it out to a deal, they still consider themselves to be holding on to that or managing that money, and so you'll receive invoices for annual fees in the 5, 6, 700 range, and it's not even money that they're taking care of. You're the
Hmm.
one kind of looking over the deal. So I advocate heavily for checkbook IRA LLC control. And yeah, I found these my vendor through Bigger Pockets. He was asking
Very
questions
cool.
or answering questions, and so eventually had a chat with him, and it went pretty well. We now have a nice relationship together where he has helped kind of educate me and get me to this point.
Cool.
Yeah,
Um, just before we go any further, I want to talk about two things. One, checkbook control is essentially you are the executor of your money, basically. You have what checkbook control, right? There's no middleman, there's no waiting, there's no multiple day lag time between when you decide to invest to when you have your funds available. That's
yeah.
correct, right?
It in the end, it results in a extremely identical process of just putting your money into your own LLC or in your own bank account. You've got a checking account. You can wire funds. I like to say you can find a deal over breakfast and fund it by lunch.
Nice. That's awesome. And from a sponsor standpoint, that's critical. I mean, I've had an IRA account when she decided to invest to when we actually got the money was almost a month. Like it was 3.5 weeks. And it was from a multiple, it was a bad scenario, but a lot of that time was waiting for that money to just get processed. And it was with a custodian.
Yeah, and it's not only is it going to take longer, but they're going to charge you more for it.
Yeah.
It's the worst of both worlds. So I like to avoid it.
So, if someone's listening and they already have money invested with a custodian, is there a way to take that money out and stop paying those fees and go with your guy, or are they stuck for a little while?
No, absolutely. I mean, as long as the deal isn't the money isn't in a deal, although you can probably do a in-kind transfer. So I don't think it'll be too complicated, but yeah, it's fairly simple. You would just the structure of a checkbook IRA is that you establish a custodial account like you normally would,
Hmm.
um, and then from there, the vendor, the one that I use, the one that anybody can really take, a lawyer can do it as well. They set up an LLC. The custodial account invests 100% of their funds into the LLC. So your only real investment, your IRA's only investment is the LLC. You then open up a
Oh,
checking account from that LLC, and
that
that
makes
LLC
sense.
can take care of all your operations from there.
Okay. Yeah, I think checkbook control is one of those things that everyone needs, but it's hard to know that you actually need it if you've never had it.
Right. Until you run into the issues that come with custodial accounts, you don't really know that it's something that you want to take advantage of.
And that's one of the frustrating things with investing with retirement accounts is it's so difficult to know what you can and can't do, which makes something like wall domain so, in my mind, important. Um, but I want to talk about what are some of the things that you see people doing that are either wrong or could be more efficiently done, or maybe just something that frustrates you about this.
Yeah, absolutely. So the tricky thing with an IRA is that you essentially need to treat this like it's a different person. You cannot actively participate in any of the deals that your IRA is invested in. You cannot, for example, put it into a flip that you yourself will manage, will put any
Okay.
sweat equity into. You cannot put it into a syndication that you're actively managing. You can't extend any credit to it. All of the expenses and income need to flow through the IRA. So this means you can't go out and buy yourself a second house or a vacation house and live in that or rent it to yourself. Additionally, the critical thing is there are disqualified persons when it comes to IRA investing. You cannot invest with your grandparents, your parents, your daughters, your sons, your spouse, anyone in a linear direction up and down. The nice thing is that you can invest with your brothers and sisters, your aunts and uncles, if you have any that you'd like to get in business with. But um, as I mentioned, consider your IRA like it's a different person. So what that means is you can invest your IRA with your spouse's IRA. You can invest your IRA with your parents or your daughter's IRA. What we've done is we put all of our IRAs together, and our IRAs are in one holding company. And you can then have a lot of funds pooled into one place and make use of multiple accounts in one, and potentially meet investing minimums, or just leverage a higher dollar value that you can put into a deal that you really enjoy, and you want to make the most of.
That makes sense. Let's switch gears and talk about taxes, because this is another thing that has a lot of questions surrounding it, is the idea of UBIT and what sort of taxes people are going to look at when they go to sell. So take us through, kind of just a basic scenario of, let's say, a multifamily syndication. Um, yeah, let's just go with that.
Yeah, sure. So taxes, you might be wondering, how are taxes present in an IRA? I thought it was a tax shelter vehicle. So it typically is. If you have just purely passive, non-leveraged income, like what I have a private money loan, you don't incur taxes. But when you start to leverage, like you do in a multifamily syndication, you start to take on taxes. Now, the nice thing is those taxes are less than the gain you'll get because of what you're investing in, but they are real, and you do need to think about them, and you do need to plan for them. So it's called UDFI, unrelated debt financed income. Let's say that a multifamily syndication is leveraged 70 to 30. 30% of the money put in is equity as a down payment. 70% is leveraged from the bank. Let's say you invest $100,000 into this property. So if you invest $100,000 and every year you get, let's say, 10% cash on cash return, 70% of that income, because 70% of it is the bank's money and not your money, is going to be it's going to be taxed. So you're going to see a tax at a 20%. What is it? The trust rate. So yeah. We've taken a look at this. We've seen when you're going to incur these taxes. The benefit with all this is you can actually take advantage of depreciation and losses. So in the same way that your personal funds, your cash would take advantage of this, if you were investing in a multifamily syndication, the bank's half of your money can. So when you're investing.
Just to stop there, because this is something that a lot of people might disagree or don't know about. You're saying if you're in a retirement account, you can take advantage of this, as far as you know.
Yes, exactly.
Wow.
So it's not the depreciation that you can take advantage of is not on your IRA's half. That is tax sheltered money that is for your retirement. You cannot take any depreciation losses on that portion. But on the 70% portion, on the leveraged portion of your entire deal, the bank's money can take advantage of depreciation, of losses, of capital expenses. And you can offset and carry forward losses the same way you would normally. I've looked at the forms with my attorney. They look identical for an IRA as they do for your personal funds.
It makes sense, because the money that's leveraged, you're paying taxes on it, right? Why wouldn't you be able to, use that depreciation on something that you're already being taxed on, if that makes any sense?
Exactly. And something that I just thought of to look out for as a passive investor, I've heard operators in the past say, "Hey, IRAs don't get to use depreciation. They're misinformed." And so they are considering actually reallocating depreciation through a PPM to their investors that only use cash funds and not IRA funds. So they want to hoard all of that depreciation for the people who could, quote unquote, take advantage of it. As a passive investor, this is why it's critical to look out for, to pore over the documents and make sure you understand what you're investing in. Because if an operator is offering you a property or a deal where they're taking the depreciation, if you're investing with IRA funds, you're going to incur a much, much higher tax bill, because these losses can really minimize the overall tax implication.
Yeah, really important to know, because I would imagine that, that's another piece of the pie that someone's got to divvy up. I can imagine someone saying, if they can't take advantage of it, we might as well use it, right? So
Yeah.
something for passive investors to think about for sure. So let's take us through the full cycle. When are you paying these taxes? Is it every quarter when you get your disbursement? Is it every year? Take us through what that UDFI tax would look like.
Yeah, it's on tax day every year in April. So you're going to get a K1 from your operator, from your multifamily syndicator. So the K1 comes in, and you're going to hand that over to your CPA, and they'll be able to kind of crunch all the numbers. The depreciation, the losses will be there, the income will be there. It's based on average debt service for the whole year of kind of how much you end up owing, and then you offset that with losses, hopefully. So what we found is, in the first 2 years, you probably won't incur any tax loss. Year 3, you're looking at maybe 0.5%, and by year 10, maybe that's when you're going to see a full percent loss in taxes. That's paid at the end of the year. You can really pay for it in a multitude of ways. You can, if you've got cash on the side that's ready to go, you can pay the tax that way, no problem. On cash flow, you're looking at minimal tax implications. So you're looking at a couple $100, 300 to, at the end of an entire deal, maybe $700, $1,000 on maybe a $100,000 investment.
Yeah, but that's not it. That's the easy part. What about
That's
the
the easy part.
sale?
Right. So on the sale, that's when you see the majority of your taxes. That comes on capital gains. Let's say you gain $100,000. If it was a 70-30 split on the debt, you have to pay taxes on the 70%. The nice thing is, you're going to have a lot of depreciation that is carried forward from all of those past years, because you wouldn't have been, making the most use of it up until now. So you'll be able to apply it to the sale at the end. It'll just have carried forward for all those years. We've seen a reduction in annual gains of about 3.8%. So a 20% deal is going to be down around 16.5.
Wow. So what's the best way you can go about eliminating this? Is it to carry forward and just keep doing these passive investments so you can keep having that depreciation?
Exactly. It's
Yeah.
the same as if you were just using personal funds. So what you would want to do is, when you get your proceeds from a sale or a refi, you want to go out and look at another deal. You want to take advantage of another high paper loss yielding deal, because the losses aren't just carried forward, they're carried forward within your account. So if you've got 2 deals within one account, those losses are applied to the same bottom line. So the losses from one can offset the gains from another, as long as they're in the same IRA account. So if you take your proceeds from a sale or a refi, and then you go invest in a second deal, and that generates a ton of passive losses in that first year through bonus depreciation and cost segregation, you can apply that to the capital gains that you had on the first deal in the first place.
So let me take you through a scenario. So I invest with my IRA in year 1. I get a refi, let's just say in year 3. Can I use personal money? Let's just say I have personal money set aside and I invest in year 5. We sell in year 6. So I have that depreciation. Does the depreciation from a cash investment separate from the IRA, would that depreciation carry over to the IRA UBIT or
No, so
UDFI?
those are 2 separate accounts. You
Yeah.
cannot mix any of your IRA investing with your
Okay.
cash investing.
So if you want to avoid paying UDFI, you have to continue to reinvest within that same account, that same IRA account.
Exactly. So
Or
you can plan
self-directed.
ahead of
Okay.
time and understand kind of how much you would end up paying. If you didn't get involved in another deal, you are looking at a fairly serious tax implication.
16 to 18%
Yeah,
tax implication.
yeah. So that's if you're investing with a self-directed IRA. There are other methods like a solo 401k and an EQRP. I know you had Daniel Lupo on a few episodes ago. He
Yeah.
covered a way that you can avoid all these taxes. If you're self-employed, there are ways of avoiding this entirely.
Okay. Interesting. Really good to know. So, what, in your mind, what is the most efficient way to, let's say someone's got 100 grand sitting in a 401k, no more, no less, they're not adding to it. What's the most efficient way to use this money?
Uh, Honestly, I would say multifamily. That's what I came to. You want an asset that is going to be collateralized through, and it's going to be there for you during a recession. It's going to be there for you when times are rough.
Mhm.
So you want to apply as much leverage. There's no opportunity within equities, within a lot of other alternative asset classes to apply leverage. If you can apply leverage to a retirement account, that is a huge opportunity. You
Yeah.
can achieve returns in excess of a far greater number of opportunities that you normally would be able to achieve with a typical 401k administrator or your typical custodian like a Vanguard or a Schwab.
Yeah. And you can, well, you could probably double that money. It's likely in an investment window period, probably 5 to 7 years. And that money, even if you did have to pay taxes on it, even if you couldn't come up with the cash, if you couldn't figure out a way to avoid it, you're still paying tax on something that you're gaining from, which is still good. I mean, you want to avoid gains as much as you can, or excuse me, taxes as much as you can. But if you're paying taxes, it means you gained something, probably far in excess what you could do with the capital markets.
Absolutely. You want to avoid this just because you're paying taxes. I mean, taxes are a slight inevitability, but you're still able to gain far greater returns than you normally would, even with the taxes involved.
Yeah.
Even if you don't have the cash on the side, you can still take take distributions out with a
Okay.
penalty if you want. It's still available to you, and you'll
Okay.
still have a greater return even after all that.
Yeah. Which is really cool. I mean, it's fun to get into the weeds and talk about how to avoid like a minute tax here and there. But at the end of the day, put your money to work. Like
Yeah.
that's the whole point of this, right?
Yeah, velocity of money is critical, and with a checkbook account, it lets you keep that velocity up really quickly. Because, I mean, for example, I one of our private money deals ended on December 15th, and on December 17th, we put it into a 568 unit deal in Memphis.
That's awesome. So you had 2 days where you weren't gaining.
Exactly.
That kills you, I'm sure.
Yeah, it was the worst.
That's great. So, I mean, what if someone wants to learn more about Walden, Maine? What the kind of education sources you offer? What take us through a little bit of what you guys are offering with this?
Yeah, so we're just a purely educational resource for you. We're going to show you the ins and outs of what you can and can't do with your IRA account. I'm not trying to sell anything. I'm just trying to educate people. It was frustrating for me to gain all of this knowledge, and I kind of wanted to just let other people know. There are many avenues you take with it passively. You can do commercial of any sort. You can do private money loans. You can invest in notes. I've got a lot of information on different investing opportunities. I've got case studies that go over what you can and can't do, the tax implications you're going to get as a result of
Wow.
certain different types of investments, and then also a nice head-to-head with um, IRAs, for solo 401ks, and EQRPs. Just taking a look at, there's a lot of information out there about the right vehicle to do self-directed retirement investing. And I wanted to do a nice head-to-head to kind of compare and figure out what's right for each individual person, since everybody's
Yeah.
situation is different.
Where can people get some of this? The case studies that you're talking about, and these are all free, right?
Oh yeah, yeah,
That's incredible. Where can they find these case studies that you're talking about?
yeah. You can find us on walltomain.com.
Cool. What and real quick before we end, I want to talk a little bit about and this is kind of funny, but Are you offering any sort of paid services for like utilizing the person, your custodian? That's what they're called, right? Like even
Uh,
the
so
person,
what would it call? I'll call them a vendor.
provider.
Provider, yeah.
Okay.
The custodian, they work with the custodian on the side. Typically, most of these people would pay a referral to me of $200. I didn't want to do that. So I just turned it around and gave it to the investors. So I negotiated $200 off their services. I've got their information on my site as well, for how you can get a better rate.
That's incredible. So they offered you a discount and you turned it away and said, no, give it to whoever comes through using my name.
Yeah, absolutely.
Wow.
I don't help people.
That's crazy. So waltomain.com.
Yep.
Awesome. Josh, I can't thank you enough. This is a very complicated topic, and this is something you've clearly put a ton of effort and a ton of education into. Thanks so much for sharing this and being such a resource for people who want to learn more about investing with this money that, maybe they see it as locked away, but this is not the case, and you're here to help them.
Yeah, there are more opportunities out there than you could ever imagine. So I hope you make the most of your opportunity out there.
Cool. Thanks so much, Josh. I appreciate it.
Thanks for having me.